Hello and welcome to Mastering Finance. I'm Dean Tellone. In this episode, we're tackling tax accounting for business owners, best practices and pitfalls to avoid. Whether you run an LLC, S corp, or sole proprietorship, navigating tax accounting can feel like walking through a minefield, but fear not. Today, we'll break down essential strategies that make tax time less stressful and more rewarding. We'll cover core strategies like choosing the right accounting method, cash versus accrual, making timely estimated tax payments, and tracking deductible expenses. We'll also spotlight common mistakes like mixing personal and business finances, misclassifying employees, and missing deadlines, and how to avoid these pitfalls. I'll share real-world examples along the way, and we'll wrap up with final takeaways and a call to action that'll inspire you to up your tax strategy game. Let's dive in. Core strategies for smart tax accounting. 1. Choosing the right accounting method, cash versus accrual. One of the first tax decisions every business owner faces is whether to use cash or accrual accounting. Under cash basis accounting, you record income when you actually receive payment and expenses when you pay them. This simplicity often appeals to small businesses. If your annual sales are under about $25 million, you're generally free to use cash accounting for tax purposes. The accrual method, on the other hand, records income when earned, even if not yet paid, and expenses when incurred, even if not yet paid. Each method has its pros and cons. Cash basis often provides significant tax advantages for eligible small businesses. For example, a cash basis business can defer income by invoicing late in the year or pull deductions into the current year by prepaying some expenses. This timing flexibility helps manage taxable income. Cash accounting also tends to support smoother cash flow. You're taxed on money when it's in hand, helping ensure you can pay your tax bill with actual cash. Accrual accounting might be better for businesses that carry inventory or where accrued expenses usually exceed accrued income, which can reduce taxable profits. Accrual method benefits include the ability to deduct year-end expenses like employee bonuses paid shortly after year-end. Example, consider a freelance consultant operating as a sole proprietor. They receive sporadic payments throughout the year and have few unpaid invoices at year-end. Using cash basis accounting means they'll only pay taxes on what clients actually paid them during the year, a straightforward approach that aligns with their cash flow. Now contrast this with a small retail shop that keeps inventory. The shop might opt for accrual accounting to match income and the cost of inventory sold in the same period, giving a clearer picture of profit. The right choice depends on your business model. Key takeaway: evaluate your accounting method annually and ensure it's the most beneficial for tax purposes. If you decide to switch methods down the line, be mindful of IRS rules. Changes often require approval and might mean keeping two sets of books, one for tax, one for financial reporting. 2. Estimated taxes and quarterly payments. If you're self-employed or running a small business, the IRS generally expects you to pay as you go by making quarterly estimated tax payments. In fact, business owners should make estimated tax payments if they expect to owe at least $1,000 in taxes when the return is filed. Corporations have a lower $500 threshold for required quarterly payments. Missing these payments or underpaying can lead to penalties. Essentially, if you don't withhold enough or pay enough during the year, the IRS will charge interest as a penalty, roughly 0.5% per month on the underpaid amount, up to 25% of the tax due. Ouch! Staying on top of estimated taxes means setting reminders for the 4 payment deadlines, typically April 15th, June 15th, September 15th, and January 15th of the following year. Use Form 1040-ES to calculate how much to pay each quarter. A good strategy is to base these payments on last year's tax liability, the IRS safe harbor rule, or this year's expected income, whichever is smaller, to avoid surprises. If you had zero tax liability last year or meet certain withholding safe harbors, you might be off the hook for estimated payments. But most profitable businesses will need to pay quarterly. Example: imagine a graphic designer who went from salaried employee to independent contractor. Without an employer withholding taxes from paychecks, it's now on them to set aside money for taxes. They estimate owing $5,000 for the year, so they pay $1,250 each quarter to cover the bill. By doing so, they avoid a nasty year-end surprise and dodge underpayment penalties. Key takeaway: mark your calendar for quarterly tax, due dates, and treat estimated taxes like a regular expense. It's a pay-as-you-go system. Following it keeps you in the IRS's good graces and your cash flow predictable. 3. Tracking deductible expenses and separating personal and business finances. Want to maximize your deductions and minimize audit headaches? Keep impeccable records and never commingle personal and business finances. From day one, use a separate business bank account and credit card for business transactions. This separation makes it easy to track expenses and prove what's business related if the IRS asks. It also protects your personal assets by reinforcing the legal separation of your business entity, a crucial point if you operate as an LLC or corporation. Common deductible expenses you should diligently track include business travel, office rent, supplies, marketing costs, insurance, and more. For example, using your personal car for business, you can deduct either the standard mileage rate, e.g. 65 cents per mile in 2023, or the actual expenses, gas maintenance, proportionate to business use. Home office in that spare bedroom. You might deduct a portion of your rent or mortgage interest and utilities. The IRS even provides a simplified home office deduction, $5 per square foot up to 300 square feet, so max $1,500. Just ensure that space is used regularly and exclusively for business to qualify. If you meet the exclusive use and principal place of business tests, you can claim those home-related costs on your taxes. To stay organized, leverage bookkeeping software or hire a professional bookkeeper. Modern accounting software can automatically import bank transactions, categorize expenses, and generate financial statements. This not only saves time, but also reduces errors. It's like having a daily audit of your books, so come tax season, you have tidy records of every deductible dollar. Good record keeping is more than paperwork. It's your defense against missed deductions and an IRS audit's best friend. Example: picture two entrepreneurs, Jane and John. Jane keeps a shoebox of receipts and regularly pays for business supplies with her personal debit card. John uses QuickBooks, scans receipts with a phone app, and has separate accounts for everything. When tax time arrives, John effortlessly tallies his deductible expenses, from that new laptop to client lunch meetings, and his CPA smiles at his organized ledger. Jane, however, scrambles to sift business purchases from personal ones. A few deductions slip through the cracks because she lost receipts, and some personal expenses accidentally get claimed, raising audit flags. Key takeaway: be like John. Separate your business finances, track every expense, and consider using bookkeeping software or a pro. You'll thank yourself at tax time when you claim every deduction you're entitled to without breaking a sweat. 4. Leveraging key business tax deductions. Now that you're tracking expenses diligently, let's ensure you're aware of the big tax deductions many business owners can use to cut their tax bill. Here are some heavy hitters. Home office deduction. We just touched on this, but it's worth repeating. If you qualify, meaning you have a dedicated space at home used exclusively and regularly for business, you can deduct a portion of rent, mortgage interest, utilities, insurance, and repairs. The simplified option, $5 per square foot, is easy, but run the numbers. If your actual expenses are high, the detailed method using Form 8229 could yield a bigger write-off. Vehicle and mileage deductions. For any driving you do for business, visiting clients, going to the post office, buying supplies, you can deduct the related costs. The standard mileage rate is straightforward. Multiply business miles driven by the IRS rate, which adjusts annually. Alternatively, deduct a share of actual expenses like gas, maintenance, insurance, and depreciation. Choose whichever gives you a larger deduction, but remember, commuting from home to office is not deductible. Only travel between business stops counts. Good mileage logs are key if you're ever asked to substantiate this deduction. Startup costs. If you launched a new business recently, the IRS gives you a little gift. You can deduct up to $5,000 in startup expenses in your first year, as long as total startup costs are $50,000 or less. Think of costs for market research, initial advertising, legal fees for incorporation, and so on. Anything beyond $5,000 can be amortized, spread out, and deducted over 15 years. This helps new businesses get some tax relief right away. It's a deduction often missed by excited new entrepreneurs who don't realize their pre-launch expenses have value at tax time. Retirement plan contributions. One of the best tax moves for self-employed folks is contributing to a retirement plan. Plans like a SEP IRA, Simple IRA, or Solo 401k let you deduct contributions you make for yourself as the business owner. For instance, contributions to a SEP IRA, Simplified Employee Pension, are generally deductible up to 25% of your net self-employment earnings, with a cap, e.g., approximately $66,000 for 2023. These plans not only reduce your taxable income today, but also help you save for the future. If you have employees, contributing to their retirement through a SEP or a 401k match is deductible for the business too. Basically, the government rewards you for saving for retirement. Consult a financial advisor to choose the right plan and maximize your allowable contributions. Other big deductions. Don't forget business insurance premiums, from liability insurance to health insurance for yourself as a self-employed person, professional fees like lawyer and CPA costs, continuing education or training, and potentially a deduction for self-employment tax. You can deduct half of your self-employment tax as an adjustment to income. And if you hired your first employees, wages and employee benefits are deductible too. The tax code is full of deductions. The key is knowing which apply to you and keeping proof of each expense. When in doubt, ask your CPA, "Can I deduct this?" Example, Mike runs a small tech startup out of his garage and had $8,000 of startup costs, legal fees, logo design, initial marketing, before he officially opened doors. In his first year, he deducts $5,000 of those startup costs immediately and will write off the remaining $3,000 over the next 15 years. He also contributes to a solo 401k and maxes it out, deducting $20,000 for retirement savings. Between these moves, Mike significantly lowers his taxable income, freeing up cash that he can reinvest in his new business. Key takeaway: know your deductions and use them. A dollar saved in taxes is a dollar you can put back into your business. Common ones include the home office, vehicle use, startup costs, and retirement contributions. Make sure you're not leaving these on the table. Common mistakes and pitfalls to avoid. Even with great strategies in place, there are some classic tax pitfalls that trip up business owners. Let's shine a light on those and learn how to avoid them. 1. Mixing personal and business finances. We touched on this earlier because it's that important. Do not commingle funds. Mixing personal and business expenses isn't just an organizational nightmare. It can cost you legitimate deductions and complicate your life if you're audited. When you charge both personal groceries and business supplies on the same credit card, how will you remember months later which is which? You might accidentally deduct a personal expense, which is a no-no, or you might miss deducting a business expense because it's lost in the blur. The IRS expects you to keep supporting records for business deductions, and clean separation helps with that. Plus, if you operate an LLC or corporation, commingling funds can even pierce the corporate veil, exposing your personal assets to business liabilities, a legal pitfall beyond taxes. How to avoid it? Open a business checking account and get a business credit card as soon as you start your venture. Pay yourself a salary or owner's draw into your personal account and pay business bills from the business account. When you need to fund the business, treat it as a formal capital contribution or loan, not just swiping your personal card. By drawing a bright line between personal and business finances, your bookkeeping will be easier, your deductions clearer, and your audit risk lower. Real-world pitfall. A sole proprietor, Lisa, used one bank account for everything. When audited, she had to explain a mess of transactions. Some business expenses, like a client dinner at a restaurant, were disallowed because she lost the receipt and her bank statement wasn't clear if it was a personal night out or a client meeting. She also struggled to prove that the $300 spent at Best Buy was for a work computer and not a personal TV. It was a stressful experience. Lesson: keep it separate from the start, and you'll avoid these headaches and preserve your deductions. 2. Failing to pay. Estimated taxes and other deadlines missed. Procrastination can be costly. Failing to file tax returns on time or pay taxes when due leads to penalties and interest that can add up fast. The failure to file penalty is generally 5% of the tax due per month late, up to 25%. If you file more than 60 days late, there's a minimum penalty, over $500 for returns due in 2025. Basically a flat fine for being excessively late. And if you file but don't pay the full tax, a separate failure to pay penalty kicks in at 0.5% per month of the unpaid amount. Combined, those can reach a maximum of 5%, 4.5% late filing, plus 0.5% late payment per month. In short, missing deadlines can cost you an extra quarter of your tax bill in penalties over time, not to mention interest on the unpaid tax. For small businesses, a frequent stumbling block is quarterly payroll reports and taxes if you have employees. Employment taxes, Social Security, Medicare, and income tax withholdings must be deposited on time, usually monthly or semi-weekly, depending on your payroll size. The IRS hits hard on payroll tax misses. These are trust fund taxes, and penalties can be severe, even if you're a solo S-corp owner paying yourself a salary. Remember those Form 941 filings each quarter and the April 15th, Sep 15th deadlines for S-corp tax returns. March 15th for partnerships and S-corp, April 15th for sole proprietors and C-corp typically. How to avoid it? Keep a tax deadline calendar. Set reminders a month ahead of each due date so you can gather info, file, and pay on time. If cash is tight and you can't pay, still file on time. It avoids the larger failure to file penalty. You can work out a payment plan for the balance if needed. And for estimated taxes, we discussed the strategy. Treat them like a quarterly bill, not an optional task. If paperwork isn't your strength, hire a CPA or tax pro who will keep you on track with extensions and filings. The fee will likely be far less than the penalties you'd rack up otherwise. Real-world pitfall. A small marketing agency forgot to file their S-corporation tax return by March 15th and didn't realize until May. The result? A failure to file penalty that grew for 2 months, plus late payment penalties. The owner also missed Q2's estimated payment because, well, life got busy. By year end, she paid several $100s in avoidable penalties. Lesson: Timeliness is money in your pocket. Use tools or professionals to stay compliant with deadlines. It's part of running a successful business. 3. Misclassifying employees as independent contractors. This is a huge pitfall that many entrepreneurs fall into when growing their team. You might think, I'll just 1099 this worker. It's easier than putting them on payroll. But be careful. If that person should legally be classified as an employee based on the work relationship, and you misclassify them as an independent contractor, the IRS and state labor agencies could come after you for back taxes, penalties, and interest. The IRS uses common law rules, behavioral control, financial control, and relationship type to determine worker status. If you control how, when, and where the person works, provide them tools, or they're core to your business, they're likely an employee, meaning you need to withhold taxes and pay the employer's share of Social Security Medicare. If you have no reasonable basis for treating an obvious employee as a contractor, you can be held liable for all the employment taxes you should have paid. That's the IRS's way of saying you're on the hook for the payroll taxes. In addition, there could be state penalties, and the worker might be owed benefits or overtime if they were misclassified. It's a mess you want to avoid. It can easily bankrupt a small business if multiple workers are misclassified and the IRS does an audit across several years. How to avoid it? When hiring, familiarize yourself with the IRS's worker classification guidelines. When in doubt, lean towards treating someone as an employee. Yes, payroll comes with costs, but it's far less than potential penalties for misclassification. If you truly intend for a role to be an independent contractor, structure the relationship to give that contractor autonomy. Let them control their schedule, possibly use their own equipment, work off-site, and perhaps take on other clients. Always document the work agreement. If uncertain, file Form SS8 with the IRS to get a determination or consult a labor attorney. Also consider the Voluntary Classification Settlement Program, VCSP. If you realize you've misclassified someone, it's an IRS program that lets you reclassify workers properly going forward and pay a reduced penalty to clear the past. Real-world pitfall. A restaurant owner had all waitstaff as independent contractors to skip payroll taxes. This went on for 2 years until an audit came. The IRS reclassified them as employees, and the owner was hit with the back taxes, both employee and employer portions of Social Security, Medicare, plus penalties for failing to withhold and remit. It amounted to tens of thousands of dollars. Lesson: don't try to game the system. If someone looks like an employee and quacks like an employee, treat them as such. The short-term savings of avoiding payroll are absolutely not worth the long-term risk. 4. Poor record keeping and ignoring bookkeeping. We've danced around this point with expense tracking, but let's call it out. Failing to keep accurate records is a top mistake that can cost you dearly. Not only do sloppy books mean you might miss deductions or misreport income, but if the IRS ever audits you, you'll need to provide documentation for every number on your tax return. Receipts, invoices, bank statements, logs, it all matters. Many business owners procrastinate on bookkeeping, then scramble at year-end, or worse, at audit time. This can lead to errors on the return, overpaying or underpaying taxes, and stress that no entrepreneur needs. How to avoid it? Make bookkeeping a habit. Whether you do it yourself with software or hire someone, keep it up to date monthly or quarterly at minimum. Reconcile your bank accounts so you know your records match reality. Keep receipts for major expenses. Some people digitize everything for easier storage. The IRS generally wants you to hold on to records for at least 3 years, and sometimes longer for certain records like asset purchases, job depreciation. If you use accounting software, back up the data. If you use a shoebox, well, reconsider that strategy and at least label things clearly. The goal is that at any point, you or your accountant can prepare accurate financial statements and verify every deduction you plan to take. Also, avoid the mistake of waiting until tax time to catch up the books. This often leads to mistakes or oversights. Running your business with real-time financial data isn't just good for taxes, it's good for decision making. You'll know if you can afford that new equipment purchase this year, or if you should wait, or if maybe you should accelerate some expenses because profits are high and you'd like the deductions now. Real-world pitfall. A contractor, Sam, used his inbox as his filing system. He figured all his expense receipts were in emails somewhere. Come tax time, he was overwhelmed trying to find everything. He missed some deductions, goodbye $500 in unclaimed expenses, and mistakenly double-counted some income because of a client's 1099 form mismatch. The chaos also meant he filed an extension, delaying his refund. It was a mess. Lesson: be organized with your records year-round. It pays off in accurate tax filings, maximum deductions, and peace of mind. 5. Overlooking help. Not using a professional or good software. Taxes are complex, and as a business owner, your time is precious. One mistake is thinking you have to do it all yourself. Maybe you've always DIY'd your taxes when you were an employee, but now you have a business, the stakes are higher. Tax laws change frequently, and what you don't know can hurt you, or your wallet at least. The IRS encourages using a reputable tax preparer or CPA for small businesses, and that's sage advice. A good accountant will save you money by finding deductions you didn't know about, ensuring you're compliant with tax laws, and helping with tax planning, like advising on S-corp election, equipment purchases, retirement plans, etc. If hiring a pro isn't in your budget yet, at least invest in quality accounting software. Modern software can guide you in categorizing transactions properly and even flag potential deductions. Some link with tax prep software for a smoother process. Also, consider using payroll services if you have employees. They will handle tax withholdings and filings, virtually eliminating the risk of missing a payroll tax deposit. Real-world pitfall. An e-commerce business owner decided to file taxes by himself to save money. He did his best but missed a new 100% deduction on certain asset purchases, bonus depreciation rules that changed, and misapplied the qualified business income QBI deduction phase-outs. In the end, he overpaid his taxes by a few $1,000s. Had he consulted a CPA, he likely would have caught those and saved money. Lesson: sometimes stepping back and getting expert help is the best financial decision. As I like to remind business owners, focus on your genius zone, growing your business, and let financial experts ensure you're optimizing taxes and staying compliant. It's an investment that often pays for itself. Final takeaways. As we wrap up this episode on tax accounting, let's review the key takeaways. Be proactive, not reactive. Choose the accounting method that benefits your business the most, cash versus accrual, and review it as your business grows. Plan for taxes throughout the year. Set aside cash for quarterly payments and keep your books updated. Don't let tax season sneak up on you. Keep it clean and separate. Maintain clear boundaries between business and personal finances. Good records are gold. They maximize deductions and minimize stress, especially if the IRS comes knocking. Leverage deductions and credits. Use the tax code to your advantage. From home office and vehicle expenses to startup cost deductions and retirement plan contributions, every dollar you legitimately write off is money back in your pocket, fueling your business or personal financial goals. Avoid common pitfalls. Make timely tax payments to dodge penalties. classify your workers correctly, and meet your filing deadlines. When in doubt, err on the side of caution and consult a pro. An ounce of prevention or professional advice is worth a pound of cure when it comes to tax mistakes. Consult professionals when needed. Even I, Dean Tellone, president of a financial services firm, rely on expert colleagues for certain tax nuances. It's not a sign of weakness, it's smart business. A CPA or tax advisor can provide tailored advice, keep you up to date with tax law changes, and serve as a strategic partner in your business's success. Now that you're equipped with these best practices, I encourage you to take action. After this podcast, set aside an hour to review your tax strategy. Ask yourself, am I using the best accounting method for my business? Have I separated my finances and kept good records? Am I on track with estimated tax payments? Am I claiming all the deductions I'm entitled to? Identify one or two areas where you can improve. Maybe it's scheduling a meeting with a tax professional, or finally opening that business bank account, or starting to use an accounting app to track expenses in real time. Commit to those changes. Your future self and your bottom line will thank you. Remember, mastering finance, especially tax finance, is a journey. Each step you take to better your processes and knowledge is a step toward a more secure, prosperous business future. Thank you for tuning in to Mastering Finance with Dean Tellone. I hope you found this episode informative and empowering. If you did, please share it with a fellow business owner and subscribe for more insights. Until next time, this is Dean Tellone reminding you to stay proactive, keep those records tidy, and don't hesitate to seek guidance. Together, let's make tax season a springboard for success rather than a season of stress. Review your tax strategy, talk to your tax pro, and take charge of your business finances today.